Now, the second quarter and first half 2022 earnings of listed companies on the Nigerian exchange has been largely positive across the various sectors, including consumer goods, industrials, and telecommunications. Some, however, have asked whether the robust financials truly reflect an economy that is weak across the main indices, such as exchange rate, high inflation, poor energy, and rising insecurity. Chatting to me now on the macros behind the earnings of listed corporates is Ayorinde, Akinloye, an associate investment research at United Capital. Great to see you again on the show tonight. Ayorinde, thank you very much for coming through. Good evening.
Good evening, Boston.
Hey, good to see you. Thank you so much. How would you summarize the first half corporate earnings so far released, and what trends did you see in those numbers?
Well, basically, in terms of the numbers, they've been quite positive across board, across all these sectors, even both financial and non-financial sectors. So, for example, for the banking stocks, although we're yet to see numbers from a couple of the big banks, a lot of the smaller banks were able to report decent growth in earnings. But the most interesting to highlight would be across the non-financial services sector. So talking about the consumer goods sector, the industrial goods sector, telecoms and the likes, they were able to report very strong revenue growth and also strong growth in profits. But when we speak to the specific trends that we observed, a lot of these companies, the reason why they were able to record this kind of strong growth was mainly because of price increases. So they've been able to raise prices significantly in order to sort of pass on some of the increased costs that they have had to, sort of face all through the year. They've been able to pass on some of, those costs to consumers. And that is why we are seeing, for example, things like inflation rates jump significantly because all these companies have had to raise prices. So that's one. Two is what we observed also was that there are signs that consumers are beginning to, sort of crack or sort of, crumble under the rising prices. So because if you look at the performance of a lot of these companies, of a lot of industrial and consumer goods companies in Q1, what we observed was consumer demand was still pretty strong. But by the time we got to Q2, we started to see consumer demand sort of wane a bit, largely because of the price increases. So those are some of the key trends. And then the last thing to also highlight is the fact that a lot of corporates also had to deal with rising, the fact that interest rates were beginning to peak towards the end of Q2. So there was an increased drive to sort of try and get debt finance in order to ensure that they have enough working capital to last them for the rest of the year.
Okay, so in a manner of speaking, are we to conclude that, look, these earnings are good, but they don't really reveal the state of the economy, that the economy is really robust?
Yes, definitely. So when we look at, like I mentioned earlier, in Q2, we started to observe that consumer demand started to wane. And when you look at the aggregate economic activities, consumer demand contributes roughly about 60-65% of total economic activities in Nigeria from an economic growth point of view, or from a GDP growth point of view, right? And what we observed was all through in Q2, a lot of, for example, you look at in the cement industry, volumes didn't grow as much. So a lot of the cement companies recorded growth in revenue basically because of price increases. So we are seeing signs of weakness in consumer demand, and that is likely going to reflect because GDP numbers will be coming in sometime next week, and we are likely going to see the impact of weaker consumer demand in Q2 on GDP numbers going forward, largely because inflation has been a big pain for consumers, who have had to struggle with income remaining stagnant, while on the other hand, companies are having to raise prices of their commodities because raw material costs, energy costs are all things that have continued to tick higher. So definitely, it's not reflective of a robust economy, but companies are enjoying the largest currently because they were able to raise prices significantly in the first half of the year. But we are likely going to see that effect wane out towards the end of the year down into 2023 when price effect, is basically removed.
So is this a function? Because if you're raising prices, let's look at consumer goods and industrial goods, for example, because of the type of economy that we have. And if you're raising prices and folks are able to absorb it, what does that say about the resilience of Nigerian consumers, by the way?
Yes, definitely. Shows that it's quite strong. Another thing that we've also observed is the consumer credit segment of the Nigerian financial services sector has grown significantly over the past 12 to 18 months. So we are seeing a lot of consumers are now relying more on taking more credits in order to finance consumption, because a lot of them income is not catching up with the rate of increase in prices of goods and services. So there's a need for them to borrow in order to at least fill in the gap for a bit of time. So that's why we are seeing consumer demand remain sort of resilient despite the sharp increase in price. Now, the question is, how long can consumers continue to hold on and continue to rely on credit, to finance their consumption, particularly when you consider the fact that a lot of these consumer credits come at very expensive interest rates. So how long are they going to be able to continue to rely on strong growth in consumer credits to finance their consumption needs? That's another story to, that would watch out for going forward. But we don't think it's something that is sustainable, and we are likely going to see consumer demand wane, particularly from Q4 down into Q1, Q2 2023. But for now, we might not see that effects play out for now.
You're just stepping into my next question when you talk about the macros and the micros that we need to watch out for in this current second quarter, and how will this impact on corporate earnings. We're done with July interest rate decision by the central bank. I'm sure we'll be looking, you folks are looking towards September for the second to the last meeting in the year. So these are some of the milestones ahead. How will this impact on corporate earnings for Q3 and Q4?
Yes, very, very critical. The macros are becoming even much critical at this point in time for a lot of corporates, because we are seeing significant direct impact on the numbers. So for example, first thing is exchange rates. For a lot of the consumer goods firms, the industrial goods firms, exchange rate is a very big exchange rate itself and availability of FX. There are two key things that impact the consumer goods firms and industrial goods firms a lot. Why? Because they have to import quite a lot of raw materials. They also have to spend on energy costs. Most of their energy costs, they are denominated in dollars, because they buy gas. For those who use gas powered plants, they have to pay for this gas in dollars and things like that. So a lot of these costs are dollar based, and if the exchange rate remains pretty much elevated at the levels where they are currently, we're likely going to see sustained cost pressures for them. Two is the general inflation rate environment. So that's talking about the general price environment. When you look at the cost for a lot of the consumer goods and industrial goods firms in the first half of the year, you would notice a significant spike in their logistics and distribution costs. For example, the cement producers, I think for Dangote Cement, for example, they spent about 111 billion on haulage cost alone in the first half of the year. So that's that was like almost 100% increase from the previous year. So that's basically speaking to how pressured a lot of these firms have, a lot of the pressures they are facing from energy costs, from distribution costs, because it's two-pronged. So diesel for powering their vehicles and distribution channels, basically, that's a significant challenge for them. So as long as inflation rate remains pretty elevated and energy costs remain quite high, that would be a key pain point for a lot of consumer goods firms and industrial goods firms in the second half of the year. The third thing is interest rates. Now we are seeing the Monetary Policy Committee continue to sustain hikes in the MPR. As long as that is sustained, it means for companies who have not been able to explore the debt markets this year, it will become more expensive for them to borrow later in the year, and this is likely going to tell on their finance costs in the second half of the year as they look to finance working capital and other capex needs. So these are all key macros that we need to watch out for as we continue to go into the rest of the year. And like I mentioned earlier, also consumer spending and consumer demand will be another critical macro variable to watch out for, and see how long consumer credit can sustain that growth.
Yeah, you're talking about the bumpy road ahead. Thank you so much for those analysis and insights. Ayorinde Akinloye, Associate Investment Research at United Capital. Thank you so much, and we appreciate it. Have a great evening.